Investing. It's the art of multiplying your wealth while keeping your risks in check. But in this high-stakes game, two titans dominate the arena: the dividend stock and the world of real estate. Welcome to the ultimate showdown: dividend stocks versus real estate. The battle between these financial heavyweights is no simple skirmish. It's a complex duel where there's no one-size-fits-all answer. What might be your golden ticket to riches could be someone else's recipe for disaster. In the red corner, we have the Dividend Aristocrats, an elite group of 67 stocks in the S&P 500 index. These titans have a track record of raising dividends for an impressive 25 years or more. But beware, my friends, for in the blue corner, real estate stands tall. A tangible asset with its own set of pros and cons, it has stood the test of time. It's the age-old debate: which path to prosperity truly reigns supreme? If you were to poll 10 different investors on this matter, prepare for a diverse chorus of opinions. It's a cacophony of perspectives, each advocating their financial gospel. Yet, beneath this sea of contradictions lies the truth uncovered by years of rigorous study. We're about to delve into the heart of the matter, dissecting the strengths and weaknesses of dividend investing versus the world of real estate. Buckle up, for this is the epic showdown you've been waiting for. Dividend investing pros and cons. Investing in stocks has long been the highway to wealth creation, and the numbers don't lie. Just look at the S&P 500 index, which recently crossed the impressive 4,560 mark. Now, rewind the clock to January 1, 2017, and you'll find the S&P 500 index resting at a modest 2,275.12. Zoom back even further to January 1, 1871, and it was a meager 4.44 points. Over this remarkable 150-year journey, the S&P 500 has delivered an average annual return of 4.7%, factoring in inflation, a testament to the power of stocks as a long-term wealth builder. But hold on, the dividend stocks have their magic to offer. Enter the illustrious Dividend Aristocrats, that exclusive club of S&P 500 companies that have sweetened their dividends for a quarter century or more. In the last decade, these dividend aristocrats may have lagged slightly behind the broader S&P 500 index, but don't be fooled. Their total returns have roared at an impressive 11.99% per year. What makes dividend investing truly fascinating is this: these stocks pay you for the privilege of ownership, not the other way around. It's like collecting rent from your investments. For retirees, in particular, this is a golden opportunity. Dividend income can gracefully step in to fill the void left by lost wages after retirement, all at a fraction of the cost of diving into real estate. But wait, there's a twist in this tale: taxes. They're the pesky price tag on the dividend investing experience. Capital gains taxes, especially the short-term variety, can nibble away at the generous returns from dividend stocks. For most taxpayers, the long-term capital gains rate hovers at 15%, but for those in the upper echelons of income, it's a steeper 20%. And don't forget those short-term capital gains, they get treated as ordinary income, resulting in a bigger tax bite. But hold your horses, there's hope. Tax-advantaged accounts like IRAs can be your shield against the tax storm, especially for those looking to bolster their dividend portfolios. Still, when it comes to taxes, the real estate behemoth bears a far heftier burden. Real estate taxes can feel like a never-ending cash drain, making the tax bill for capital gains and dividends look like pocket change. But fear not, for dividend investors have their ace up their sleeves: the Roth era, a haven from the taxman's grasp. Yet, let's not skirt the truth here. The most glaring drawback of dividend stocks is crystal clear: they won't put a roof over your head. Now that we've weighed the pros and cons of dividend investing, it's time to dive into the enticing world of real estate investment. Real estate investing pros and cons. Comparing dividend investing to the realm of real estate is a bit like weighing apples against oranges. It's not an either-or scenario because, let's face it, the dividend investor still needs a roof over their head. Real estate's allure lies in the power to build equity and eventually break free from the clutches of perpetual rent payments. While renters keep pouring money into someone else's pocket, homeowners chart a course towards significant wealth. You see, owning a home isn't just about having a place to lay your head. It's a path to financial independence. With every mortgage payment, you're not just keeping the rain out. You're building your empire. Real estate offers more than just a cozy abode. It's a potential income generator, often through renting. But tread carefully, for this path comes with its own set of challenges. Yet, let's not paint the whole canvas green. Over the past few decades, real estate hasn't exactly been the golden goose. Consider the Case-Shiller Home Index. As of December 1, 2021, it stood at 280.19. Rewind to December 1, 1890, and it was a modest 112.77. This journey paints a humbler picture, with U.S. homes returning a modest 0.7% annually in real terms over 130 years. Now, stack these numbers against the roaring returns of the S&P 500 index mentioned earlier, and the contrast is glaring. But here's where the tale takes a twist. Real estate, while promising, comes with a hefty bill, the cost of ownership, the silent assassin of returns. So, when someone boasts about selling their $200,000 house for $500,000 after 3 decades, don't be too quick to assume a $300,000 windfall. Beyond the mortgage, there's a parade of expenses, from interest payments and closing costs to insurance, taxes, and homeowners association dues. Then let's not forget the ongoing maintenance costs, new appliances, furniture, and the like. In some cases, the homeowner might end up in the red, even if the sale price appears to be a massive gain. All thanks to the relentless cost of ownership. Now, real estate does have its perks. Homeowners can deduct a slice of their mortgage interest from their annual tax bill. However, in the face of rising interest rates, affordability is taking a hit. With the average 30-year fixed mortgage rate hovering around 7.25%, it's a far cry from the double-digit rates of the early 1980s. The real estate journey, it seems, has its twists and turns. Final thoughts. Here's the undeniable truth. There's no one-size-fits-all solution in this investment game. The stock market has minted millionaires just as real estate has. It's a diverse playing field with room for many success stories. Now, let's shine a spotlight on the dividend aristocrats, those steadfast champions who have not only outperformed the broader market but also left real estate trailing in their wake. They've achieved this with the poise of a seasoned marathon runner. Investing in dividend stocks is the slow and steady ascent to wealth, where consistency is the name of the game. On the flip side, real estate is the land of leverage. Many homeowners roll the dice with just a 20% down payment, effectively borrowing 80% of a property's value. Picture this: a $500,000 home and investors are leveraging a cool $400,000. Leverage, you see, can magnify your gains. But as history reminds us, it's a double-edged sword. The 2008 real estate crash left many Americans reeling, a harsh lesson in the unforgiving nature of leverage. As we wrap up this exhilarating exploration of the age-old clash between real estate and dividend investing, we hope you've gained valuable insights into these wealth-building giants. The financial world is a complex battlefield, and choosing the right strategy is no small feat. But hold on to your seats because the battle doesn't end here. If you're itching to dive deeper into the realm of financial warfare and discover the ultimate showdown between real estate investments and cryptocurrencies, simply click on the video highlighted on your screen. It's a heavyweight bout of financial supremacy that you won't want to miss.